Assalamu alaikum. So I received many requests to review WealthSimple's Shariah World Equity Index ETF, ticker symbol WSHR, and that's exactly what I'll be doing in this video. To invest in this equity ETF, you have to have access to the Canadian Stock Exchange. We'll start with an overview of this ETF. Under their About, they say that WSHR complies with Sharia law and excludes companies deriving more than 5% of their income from alcohol, tobacco, pork-related products, weapons, conventional banking or insurance companies, and adult entertainment. The ETF also excludes companies with excessive leverage, meaning debt. And we'll go over in more detail the specific criteria, the financial criteria that this company uses. The ETF and its underlying index have been certified by a team of Islamic researchers at Ratings Intelligence Partners, and dividend purification information is made available quarterly. So as it relates to their cost, they say that their products have market-leading fees. They charge a 0.5% management fee, which actually is high compared to passively managed ETFs, which is what this particular ETF is. It is passively managed. If we go to our good friends at Investopedia, we see that for passive or index funds, the typical ratio is about 0.2%, but can be as low as 0.02% or less in some cases. So there's actually 30 basis points difference between the typical ratio for a passively managed ETF and what WealthSimple is charging. WealthSimple is charging 50 basis points or half a percentage point, which is 2.5 times larger than the typical ratio. And now in their defense, they say we charge a 0.5% management fee compared to over 2.5% for the leading Canadian Sharia compliant mutual fund. Not sure who they're referencing, but 2.5% is an outrageously high percentage point. Taking pride in comparing yourself to that type of fee is like saying that you're the tallest building in Tora Bora. It's not really a good metric to measure yourself against. The fund that is charging 2.5% management fee better be earning Fidelity Magellan Fund under Peter Lynch type returns. Otherwise, it's woefully overpriced, and I have a hunch that they're not achieving those returns. Long story short, they are on the expensive side for passively managed ETFs. Now let's look at the criteria that WealthSimple uses in order to screen for Sharia compliance. So the first thing to note is that this ETF tries to track an index, and that index is the Dow Jones Islamic Market Developed Markets Quality and Low Volatility Index, which is a very catchy name. If you look at this particular index's performance and we compare it against the S&P 500, you have the line in blue for the S&P 500. The Dow Jones Islamic Market Index is in the white, and the S&P 500 in the past year had a loss of 11.5%. The benchmark index for WealthSimple had a return of minus 16%. So they've underperformed the S&P on the downside in the last year. Now, if we look at the last 3 years, we can also see that the S&P outperformed the benchmark index for WealthSimple by around 6 percentage points. So the S&P 500 returned an annualized return of 8.5% compared to the benchmark index of 2.6% for WealthSimple. Now, keep in mind the launch date for the index was actually November 2nd, 2020. So any returns prior to that were actually theoretical based on this chart. Now, if we look at the actual returns of the WealthSimple ETF, because remember, the ETF is meant to follow the index, it's not the index. So if we look at their year-to-date performance, it was close to negative 17% versus the S&P, which was negative 19.6%. So a bit of an improvement over the S&P. If we look at a year in history, we see that the S&P actually outperformed by about 1 percentage point compared to WealthSimple's ETF. Now let's talk about the screening criteria that WealthSimple uses for its companies. So they mentioned that they use the services of ratings intelligence partners to screen for Sharia compliance. Now, if I go to Ratings Intelligence's website and I look at their screening criteria, they have non-permissible income over revenue should be less than 5%. Industries that they exclude include alcohol, financial services, gambling, pork-related activities, pornography, tobacco, advertising, media and entertainment, trading of gold and silver as cash on the deferred basis. So any sort of hayal around riba they tried to avoid. Now, for their financial ratio screening, you have accounts receivable over market value of equity has to be less than 49%, and the market value of equity is calculated on a 36 months average basis. This criteria is just completely superfluous. You can have 100% account receivables and still be a completely halal business. Having accounts receivable in and of itself is not something that should count against you in terms of whether or not you are a halal or haram business to invest in. The second criteria that they have is that cash and interest-bearing securities divided by market value of equity, again, using the 36 months average for the market value of equity, should be less than 33%. Now, as it relates to interest-bearing securities, that may make some sense, although interest-bearing does not take into account the interest rate that is on those securities. So in my mind, it makes much more sense to actually focus on the amount of interest than just the dollar value of the securities that bear interest, because that's not what is prohibited. Interest is what is prohibited. But cash is also a head scratcher. I don't know why cash would count against the company being Sharia compliant or not. And then the third criteria that they use is debt over market value of equity, again with the 36-month average, should be less than 33%. And this goes back to my earlier comment regarding the interest rate on the debt being important. An interest rate of 0.5 percentage point matters less than an interest rate of 15%, and these interest rates should be taken into account. However, just because this particular screening company is using these criteria doesn't mean that they're going to end up with non-compliant companies in their investing, because what this superfluous criteria is going to do is it's going to reduce the number of companies that qualify, but it won't add companies that should not qualify. What I did not see is an emphasis on any sort of qualitative screening for the companies, which I think is important to see if the management of that particular company actually conforms with the spirit of Sharia compliance in their behavior. Nevertheless, I think what they provide in terms of usefulness is basically right here, which is excluding companies that belong to any of these business sectors that we mentioned. Now, finally, to categorize the types of companies that this particular ETF invests in, they are a blend of value and growth, and they tend to be large in terms of market cap. Additionally, they do tend to be rather dispersed geographically, so you can see that the United States has 33% weight in the portfolio in terms of geographic weight. Japan has 17.2, Switzerland 8.3, and they also are diversified amongst industries as well. The top holding in this particular fund is Nestle, followed by Hong Kong and China Gas Company, and perhaps their geographical diversification is they're lagging behind the S&P, as we saw, because the United States tends to outperform other countries most of the time. In conclusion, I find WealthSimple, to be completely honest, just your garden variety ETF that is targeted towards Muslim investors. I think it's a decent choice if you have no other choices. Certainly if in your employment they have a choice between this ETF and Billy Bob's alcohol and tobacco emporium, then I would go with this ETF. If you're interested in following my investments in my portfolio trade for trade, you can do so at practicalislamicfinance.com. Just become a member when you get there. If you enjoyed this video, do me a favor, leave a like and subscribe. Until next time, make sure to take care of yourself. Assalamu alaikum and peace be upon you all. Oh, actually, assalamu alaikum and peace be upon you all.